Welcome, everyone. I'd like to start off with a quote, which I think is basically could sum up the reason that we are actually having this symposium today. And before I do that, I would like to thank a few people. And the first person or institution I would like to thank is the Dutch Central Bank, very, very much for hosting us here and for welcoming us. I would also like to thank two members and recognize two members of our current governance that are here, and this is Mr. Buford Alexander, who is the foresitter of our supervisory board, and Stephen Camphor, who is one of the members of our advisory council. So thank you very much for coming. And I would also like to recognize a person whose leadership is actually behind this idea for this symposium, and this is Jules Mouse. He was introduced to me via our chairman, Buford. He noticed that we were missing one thing of our curriculum on courses, Amsterdam Institute of Finance, and that was systemic risk, and introduced that to us. And I thought, well, this is not something that is easily made into a program or a course. How do you teach what is the right way to handle systemic risk? We do not yet know. I don't know if we will ever know, but that's what we are here to find out today, listening to various experts that we have had the very fortune of assembling today. And Jules can unfortunately not be here. There's a paper of his that will be available afterwards, very interesting paper that he has written. But the quote is, "All hell broke loose." So I would like to start off with that, and let's see what comes out of this symposium. Thank you. All hell broke loose, not meaning today, but meaning with the crisis, of course. I would like to welcome a man that needs no introduction, Mr. Alexander Renoy Khan. And he has served as a member of our advisory council for many, many years, and is so gracious as to actually give the opening talk here for our symposium. So, Alexander?
Thank you very much, Brenda, for setting the stage so nicely. It is a pleasure and an honor to play this minor role, but at least one thing that I can do from one of the roles that I currently play is to once again welcome you to the Central Bank. I joined the supervisory board a few months ago, so that at least gives me an excuse to be here. I realized, looking at the preparation, that there is another role that I'm reminded of right now. I'm currently chairing the jury that will award the Dutch version of the Oscar in a few days. So I've been watching a lot of movies recently, and I realized that title-wise this symposium could have been one of them. If you look at this systemic risk, assessing the threat, it has all the makings of a disaster movie. So imagine, if you will, that this is the opening shot of this great movie. We are all assembled here. And of course, as you know how these movies go, the atmosphere is still relatively peaceful. Everything seems to be fine, but there's some dark music in the background, and the audience knows all is not well. And something will happen between now and 90 minutes that will remind us of why the title is Addressing the Threat to begin with. So, starring Tom Cruise, if you will, hold on to your seats. It could be a rough ride, not necessarily the next 90 minutes, but over the next 1 or 2 or 3 or 5 years. Systemic risk very much has become a part of our lives, certainly many of your lives. And today the attempt will be to talk about how we could possibly analyze it and maybe even cope with it and address it appropriately, addressing the threat. And the background against which this debate takes place is all too familiar to many of you. We all know that global financial markets are still not back to normal, that there's still a lot of debate about the solidity of the main players in those markets, the financial institutions that many of you are associated with. We all are painfully aware of the tenuous relationship, if you will, the negative feedback loop that now exists between the financial sector and the real economy, and we also are painfully aware of the tenuous relation between the banking sector and the sovereign nations behind them. So that accumulates into a real challenge, and one well worth addressing, and well worth addressing especially by the distinguished experts that are here today. Let me say a few words about where the motivation comes from. And I suppose the very first motivation is the simple observation that the financial crises that we are talking about are extremely costly. A lot of money is involved. How much? Well, the computation is still ongoing. But of course, if you look at the current crisis, IMF recently estimated that the direct cost borne by taxpayers in the average crisis is about 15% of gross domestic product. That is already a huge amount of money. But of course, that is just the direct cost. If you add indirect costs, and every crisis has a lot of indirect costs, loss of output in particular, then the number becomes even larger for the Netherlands. The current estimate based on what happened between 2008 and 2011 is that the accumulated loss of output is about 23% of our GDP. Let's say about 150 billion euros. So again, a huge, huge amount of money, and certainly on its own already a very good reason for supervisors to want to reduce the frequency of the crisis and the depth of each one of them. Of course, the ultimate challenge would be to really prevent them. Many of you are aware of efforts to do exactly that, and many of you, I think, will share my assessment that that will be almost impossible on a rather principle basis, but more about that in a minute. When we talk about systemic risk, I suppose that at some point somebody has to come up with a definition, and at the same time I'm pretty sure that all of you are pretty well aware of what we are talking about. Let's talk about systemic risk in the sense that it is the risk that multiple institutions or multiple markets would fail that otherwise would not have failed. So let's call it a risk associated to the financial system as a whole. It can, of course, be caused by individual institutions, most notably those that are supposedly too big to fail, or it can be caused by widespread shocks that simultaneously affect a number of them or a number of markets, for instance, the bursting of an asset bubble. And again, I'm sure that several examples come to mind immediately. Systemic risk can take many forms, and many of them I'm sure will be reflected upon later today. Let me just name a few perspectives here. First of all, systemic risk, as I understand it, is very much related to the notion of fundamental uncertainty. Fundamental uncertainty, which was introduced by Frank Knight in the early 20s of the last century and reinvented by Donald Rumsfeld when he talked about the unknowns. And that uncertainty refers to a situation where we simply have no basis for whatever estimate we would like to make, because there is simply no experience that we could base those estimates on. There is nothing known about the type of probability or indeed the type of event itself. So forecasting then becomes a pretty hopeless effort. One ingredient that makes systemic risk so hard to address and to measure. The second ingredient that I'm sure many of you will recognize is the notion of complexity and the complexity of the financial system. And again, all of us know that that complexity has gone up over time, that we are now looking at a number of financial institutions that are extremely complex by every definition. Some of today's banking groups have more than 1,000 independent legal entities, operate in more than 40 countries. That alone accounts for the complexity that I'm referring to here. And of course, we are all, if not aware, certainly painfully aware of the complexity of some of the financial products that have emerged from this complex system, which on top of everything else is also based on regulation that has to do with very complex capital standards and valuation standards. There is, I think, a very interesting link between these two first ingredients, the fundamental uncertainty and the complexity. And a thought that I want to leave with you is that the developments that we've all faced, and that are by and large positive ones, where global markets have emerged, especially global capital and financial markets have emerged, at the same time it basically altered the nature of the economic system that we're all part of. With all these linkages going on and on, one uncomfortable possibility could very well be that the system that we are now part of increasingly resembles the meteorological system, which is also characterized by a lack of respect for what national boundaries represent. And so that system is characterized by a very fundamental uncertainty. Many of you will know the famous metaphor by Lawrence, who said the wing of a butterfly in Beijing can cause a rainstorm in South America a few hours later. That is precisely what I'm talking about here. These systems, this system at least, this meteorological system, is fundamentally a non-linear system. And that, I think, as a technical term, simply tries to pin down that in that system, small causes can have very big effects. The linear systems that we are comfortable with, that form the basis for our econometric modeling, do not have that property. Small causes have small effects. That makes us comfortable and at least gives us a sense of control. But if what I say is basically correct, or at least resembles part of our new reality, then we have to face up to the fact that in this new world that we have knowingly and willingly and eagerly created, small causes, let's say a small mortgage problem in a small part of the United States, can have very big effects just a few weeks or a few months later. If that is true, then indeed the complexity of that new world also causes directly that fundamental uncertainty that is not a consequence of a lack of knowledge on our part, not a consequence of a lack of appropriate tools on our part, but that really captures some inherent feature of that new world that we simply have to learn to live with. So that is already an explosive mixture. On top of everything else, there are such things as the homogeneity and the procyclicality of the financial sector itself. Very homogeneous, moving together, reacting in a similar fashion to whatever happens in the outside world, and as such exacerbating what might have happened otherwise, but perhaps not as seriously as it happens in the real world today, tomorrow, and perhaps for many years to come. So here we have, again, I think, the ingredients for a very explosive mixture. And not surprisingly, there are many lessons that we would like to learn and many insights that we are desperately in need of. Of course, the academic community has taken up this challenge, has tried to provide us with tools to predict crises, to find early warning indicators, but in light of what I just said, you might already suspect that this is almost an inherently impossible task. Certainly, it may be possible to develop, let's call it a thermometer, to measure systemic risk to some effect, but to develop a barometer that would allow us to forecast systemic risk may be really over-asking, again, in a very fundamental sense. What are the lessons? What are the key questions for policymakers? Certainly this notion of fundamental uncertainty has uncomfortable implications for them as well, because it seems to imply right away that it is inherently impossible to predict everything, and therefore to prepare for everything is also inherently impossible. At very best, policymakers can possibly hope to identify some well-defined sub-problems, a limited number of known problems, inherent problems, each of which may be addressable, but the sum total of which may yet remain beyond our control. And at the end of the day, the only non-regret option that seems to emerge, and that of course is currently being pursued very eagerly, is simply to increase the buffers within the financial system itself. Because whatever happens, this is truly a non-regret option, it will make the system more resilient to shocks. So by ensuring the presence of those buffers, sufficiently strong, sufficiently big, a robust infrastructure, if you will, at least one could hope to create a system that would be capable of absorbing vulnerabilities that materialize to a somewhat more satisfactory extent than we can currently do. And the introduction, for instance, of a counter-cyclical buffer in Basel III is a good example of the kind of regulation that has been designed specifically with that aim in mind. Crises are of all times. We know that, and I think we've learned to accept that. And each next crisis comes as a surprise to the survivors of the previous one. One of the very first crises took place in this very city many, many years ago in the 17th century. I'm referring, of course, to the tulip mania. Now a great story, then a real disaster. You all know what happened. Bulbs were initially precious and rare, and at some point, when increased demand created a rise in prices, all of a sudden a futures market emerged that was totally out of control. And at the end, the price of one tulip bulb surged to levels between 3,000 and 4,000 florins in those days, more or less the annual income for a craftsman, so you can easily translate it in today's terms. Great stories. One story that I really like is a sailor who returned to Amsterdam, sat in the kitchen and noticed this strange-looking onion that was lying on the table, and cut it in small size pieces and sort of ate it, and didn't really like the taste. When his host returned, he was less than pleased, as you can imagine, because his annual salary had just disappeared. So it went, but of course it ended very badly, as these crises always do. And at the end of that particular day, again, there was a strong intention to avoid that particular crisis from ever re-emerging. I think we have managed to avoid another tulip crisis, but many others have emerged in their place. And of course, in that sense, every crisis is different from each other. I hope that today will help all of us to get a somewhat firmer grip on many of those issues, perhaps not with the illusion that at the end of the day we will feel in complete control of our own futures, but perhaps somewhat more aware of all the risks that are around us as a result. And then I think already we'll have an afternoon that has been well spent by any standard. I'm grateful for the AIF to organize this. I'm grateful for the speakers to be here. I'm looking forward with you to an enjoyable afternoon. Thank you very much.